Alright guys, good afternoon. Welcome to the mentored session. Right, what we're going to have a look at this week is changing your mind. Last week we were looking at the idea of not getting out of trades and sort of holding on to your trade, particularly when there's scope of movement, and not trying to get out just to reduce risk or to try and book some profit quickly, particularly when there's a very, very large potential of a trade. So let's go and have a little look at what I'm talking about. And this relates to the gold trade that me and Iwo were talking about earlier on this morning, the sort of very short-term reversal trade in gold. Now, for any trade, in order to be able to change your mind, you need an original plan. If you don't have an original plan, you can't change your mind because you don't really know whether the trade is actually adhering to the plan or not. And so that's a real key thing to be aware of, that if you're not sure what exactly it should be doing, you have no idea whether you should or shouldn't be in the trade. And this is why entering just because you have an entry point is not sufficient. You need strong reason to be in the trade. That's crucial. So you need your original plan, which should clearly have an entry point, a target, and a stop. Now, with a target, as we kind of discussed before, you can't have a runner of a trade. You've got to at least have a minimum target that you're going to look for. Once you get beyond that, then you can make a decision about what comes next, where the market can go to after that. But you can't just simply go, I'm going to let it run and see what happens, because that puts you in a dangerous position of being in a trade and not knowing what to do. And again, it comes back to that. How do you get out of the trade? So change your mind then. This comes when incoming information doesn't adhere to your plan. And this is all about expectations. You need to have an expectation, not just of where your market can go, but how it's going to get there. If you've got that, then you can assess whether it is doing not just what it should do, but is it doing it in the right way as well? This is the bit that allows you to then change your mind, particularly if you've yet to reach your target. So it's all about asking yourself, does it match expectations? But not only that, for some trades, not matching the expectations of the way it's going to move is okay. You can allow the move to continue, because it may well be, say, on some kind of breakout type move, just because it doesn't do it in quite the speed that you might expect, as long as it has put in the breakout, then the move is still on, and slowing down is still maintaining that movement. And so whilst it's not exactly what you might have expected or perhaps wanted, and this is important to remember, there's a difference between what you expect to happen and what you would like to happen. We would all like a trade when you enter that it goes tick, tick, onside, whoosh, straight to target. That's what everyone wants. Of course it is. But that's not necessarily an expectation. That's an ideal. Yeah, that would be wonderful. But for many trades, you have to understand how it's going to do it, how it's going to get there. Because if you can understand that, then you don't get flustered. You don't fall to the mercy of doubting a trade as it's happening, because you can see what's happening. You think, yeah, this makes sense. This is what should be happening. Another question as well is time. Is this an important factor in the trade? If you're playing the European equity drop today, time's not that much of an important factor. Once you'd started to put the move in, particularly if you're looking at Euro stocks down towards 62, once the move was started, when you got a break through yesterday's low, you got that drive out of the initial balance. Once that's on its way, time doesn't really matter so much, as in, this doesn't have to go and break 62, which is the bad lows from a week ago or so. It doesn't have to do that instantly, but it could. Equally, if it takes a bit more time, that's okay. It's still doing what you expect. Whereas for that gold one, time does matter because of the structure of the trade, because of why you're taking the trade on. So the next thing is then exit. Asking yourself, where is it appropriate to exit? This is crucial in terms of not getting out just because, you've lost some of the reason to be in the trade, just get out. You want to be more looking at this and saying, right, well, I've got these reasons to be in the trade. it's not looking so good now, but I can get out here. I can take something off here, and this is as good as I can get. You're trying to optimize a perhaps bad situation, or a situation that is lower quality than it perhaps was. And the other question, make sure you ask yourself, why are you exiting? If you're exiting because of P&L, because of boredom, because of you just don't really like the order flow, are they really sufficient reasons, or are they a different way of saying, I don't want to lose now and I just want to bank my profit? Because if that's really what you're saying, that's not a reason to exit the trade. Right. So coming into this idea then, context matters. You need to understand the context. This is how you're going to have an original plan. With gold, I talked about this morning. Wider context is this is a very, very balanced market. So any trade between 1920 and 1952 is likely to be two directional. It's likely to be a market that is not going to sustain directional movement. It may be able to put it in short term, but it's not going to be able to sustain it. So immediately you're already leaning away from more breakout type trades. You're leaning away from more sustained direction trades. You can still play breakouts, but expect them to be short-lived, expect them to run into difficulty. Whereas if it goes to the downside, once you get that break of 1920, you can start looking down towards 14, towards 9, towards the recent lows. Now you can expect more movement because you're breaking away from that well-traded area. So you immediately have a contextual understanding of how the market's likely to move, roughly. Then you can start to bring this down into much more detail. So this brings us on to the actual trade. Now, the early trade, and I'm not going to talk about the breakout to the upside, but a great thing to do when you're looking back over trades is ask yourself, how else could I have played this trade? Because we're going to look at the reversal move. But look at this from a point of view of asking yourself, well, how else could I have played this? Could I have actually played the move up and used the reversal information as your reason to get out of the long? So flip it over on itself as well. This is a great way of finding new trades. So the idea of the trade this morning then, you've had false break of the overnight range through 20. That was the area where it could start to go down. It doesn't do it. Gets through there, bounces back, and then you get the break of this little range towards the upside. Break there, you can look for the breakout trade. Now, like I said, this is not a breakout trade where you're looking for a great deal. This is a breakout trade where you expect short-lived move, possibly getting back up through value, up towards recent resistances that come in at around about 35.5 area. Anything up there could well be the end of the move. You're not expecting sustained move. So it puts the move in. And in doing that, what it also does is it creates a stretched profile. So this is where the trade idea comes from. You have to ask yourself, right, when I've got this situation, this shape of profile, what can happen? How does this resolve itself? You need to be able to have that ability to say, right, there's two ways that this can happen. One, it can reverse the move. It's an elastic band trade. The market has moved too far from value and it's going to get snapped back. Two, it can be a continuation move. This is a break towards the upside, in which case you want to see value shift higher. So it's going to take time. Value shifts higher, volume shifts higher, then the market can keep on going. So immediately you've got information about time here as well. It needs to do this quickly if it's going to reverse and slowly if it's going to continue. So you've now got a bit of an idea about how you might want to try and look at this type of movement. I.e., if you want to play a continuation move, you don't need to rush. If you want to play a reversal move, you might need to be a little bit quicker on this. So here we go. This was the move that I talked about. This is the one that I put up in the group. You get the breakout. That's not a big surprise. That's an absolutely fine movement. That's all good. You get this fast move up and then very quick delta flip over. So seeing that you've got a stretched profile, seeing that delta has flipped, you can now start looking at this on the basis that we're already in an area where you don't trust breakouts that much. You're expecting two directional trade. Your idea now can be quite clearly defined. There's a small range here, around about 37s down to 34. That was the previous high. Break the previous high, market can fall. And the idea being we can fall back down towards 30, 29 area, top of single prints, top of value, bottom of single prints, top of value, where we kind of broke out from earlier on. So you've got a pretty clear target. You've got about a 50 tick target. You can give yourself a stop just behind this secondary low, which comes in at 34.6. Put your stop behind there, 34.8. Gives you a decent stop. 35 if you want. It gives you a 10 tick stop. I know people look at gold and think, oh, it's very volatile. 10 tick stop can be absolutely fine in gold. So there we go. You've got the clearly defined trade. Now you've got to look at it and say, right, what am I expecting to happen? Now remember, I talked about the idea of this being an elastic band. If it's to be an elastic band, you expect it to go back quick. Now, having seen many elastic bands, what will generally happen is it will start to move, and as it starts to come off, buyers are still going to come in because they're still looking at this thinking we can get a bounce. Once those buyers have been defeated, that's where the acceleration comes. That's where that second move down comes, and you get this quicker move. Because people try to buy the dip, they then realize it's not going to go, they don't hold on to it, and then you get this second flush down. So from where you are here, your objective is to be short below 34, either on the break or on the pullback. And this is why you keep your stop up here so that you're not getting stopped out on the little pullback to 34, and why you never move your stop to a scratch. Don't move your stop to a scratch. You're short 34s. You're now looking for 30. We've had a little dip. This is the first drop, and then you start to get this bid back. That's fine. Buyers coming in here just need to get it back above 34 for the move higher. If they don't get it though, the people buying the dip here are going to get forced out. And this is where you expect that quick elastic band suck back down towards where value was previously. Alternatively, the longer it spends here, the less and less convinced you should be, because elastic bands need to happen quick. Otherwise, they accumulate volume, which then means that the move is dying out. It's building up volume, allowing for continuation. So if you don't get the green move that comes quick and you start seeing red, this is information to say you might want to get out of this trade. So let's go and have a look at what exactly happens, and I'll bring you the chart in and roll it through from that point. So here we go. So this is where you are. Remember, you're looking for a break through 32.2, quick move down, really into this little area here, 28.9, 29.5. This area just down here is your target. So at this point, you're thinking, yep, you're all good. You're short somewhere in here. This is fine. There's no reason to exit the trade. Nothing's saying get out. Delta's starting to tickle up a little bit. Is that a worry? No. And this is what I mean by that. That's a little bit of a reason that you might want to doubt the trade. But on the whole, the idea of the trade is still fine. We're below that confirmation point at 34. The idea that value has not been shifted higher yet means that this trade is still an entirely viable opportunity. So we're all looking good. We tick down, Delta still staying up. We continue to sit sideways. This is okay, but the longer and longer it goes on, the more and more you're going to start to doubt it. You want to see if we can get through 32. Now, for me at this point, I'm always looking at it thinking, right, I'm not happy that this isn't doing it quickly, but equally, it's not going back on me just yet. So I want to give it the chance to have a go through 32. So on this basis, still in the trade, stop still up here. We're still going to wait this one out. Delta's still ticking against you as well. It's starting to tick up. There's starting to be a little bit of doubt in this. Then you get this drop. That's good. That's what you want to see. There's the acceleration down that you want. So all good. Volume goes up, acceleration down. Look at the delta though. This goes the opposite way. This is not good. So now you're getting to a point where we've actually spent more time up here. We're building time up here. We've had the acceleration down, and this gets ripped straight back. You're now starting to think, This is losing the reason to go down. We're building up more and more volume higher up. If I bring a profile in, granted this is only going to be a profile on this bit of the trade. This is the bit on the move up. We then start to build more and more volume in here. This is now starting to accept value higher and higher up. So straight away you're thinking, I'm running out of reasons to be in the trade. So you can ask yourself, right, if you think you've got enough reason to be out of this trade now, your stop is still in the same place. Where's the best place you're going to be able to get out? Perhaps somewhere around 32. This is where we've been holding previously. So you can then start looking at that as your place to exit. And this is why I wouldn't be just going, oh no, just get out as soon as it comes back up here. You're not wrong here. And yes, of course, it's not ideal if you get stopped out, but your stop is less than 10 ticks. So being willing to sit through this, you're still going to be able to get about 20 ticks out of this, or around about 20. And the market continues onwards. By this point, you can be very confident that this is not going to do what you're looking for. It's certainly not doing the elastic band in the way you'd want. It should be doing this quickly. And it's not. So with it not doing that, you can then look at it and you say, okay, this isn't the trade that I'm after. Anything that comes down here now towards the sort of mid 32s, you're quite happy with as an exit. Market continues. More than happy, I would say, to be getting out here. I think all the information you've got up to this point is saying you don't really want to be staying in this trade. It does kick up a bit of volume, and that's likely to be the point where you go, brilliant, it's given me that little flick down, it's given me enough of a reason to get out of this trade. The move does continue, and this is where I don't think you can justify staying in because of this. In hindsight, oh yeah, absolutely, just keep your stop up here and stay in. But the information you've gained here compared to your expectations do not suit this trade. Delta's going up, spends a long time here balancing. This is not what you'd be looking for. It does roll over and the market does roll back down, but I would not be looking at this as a reason to really believe in this as a move down. This, I think, is a secondary trade. This is something that comes as a secondary idea, perhaps once you're below 30, perhaps more so once you're back inside what was the previous range, then you can look for a move down. But I don't think playing it from here all the way down is a trade that you can really look back and say, yeah, I could be really confident of that here, because the information you're getting here compared to your expectations does not suit this idea. So there you go. That's the idea of changing your mind on a trade. You can be willing to do it, but make sure you have the right criteria and the right reasoning for changing your mind. I'll wrap it up there, guys. Have a great rest of your day. I'll catch you all tomorrow afternoon. See you all then.